Hey guys, this is a peek at my journal I have here. This is for September. Not really sure how I want to organize everything, but basically this is just on Google Drive. Um, and so, yeah, this is for this week. This is what happened for my oil trades. So you can see here Monday, September 22nd. I'm just going to quickly read here. I had some sloppy execution, but won the trade. I entered with six contracts on oil, and then I added three more, and then I removed one, and I think I was just trying to make sure I wouldn't lose more than $100. I didn't have more than $100 worth of risk on the trade, but I guess I just need to do better with my, calculation of risk on TradingView. That was sloppy, but I stayed I stayed firm in the trade. Price retraced where I wanted it to, and I entered, and price hit my TP. So on Monday, I got a win, $240. I also left a note here. It says here you need to look into 3-minute candle close versus 5-minute candle close. The reason I say that is because there was a weird situation where price opened above the zone. Price opened above the zone, but the previous candle was closed below the zone. So I looked at a 3-minute chart, and on a 3-minute chart, the candle did close above the zone. So basically, I just took a leap of faith that decided that that was a candle closure outside the zone, so that the bias is bullish short term. So I think I'm going to do a little bit of a study to see if entering a trade using the 3-minute candle closure is worth switching to. So that might be a video for the future if I end up finding that that is viable or profitable, I should say. On Tuesday, price reached my TP, which is basically just one RR of the opening range. It actually hit TP before retracing at all, so there was no trade there on that day because my strategy is to wait for a retracement into the zone before I enter. Okay, and it would have been beautiful if there was, see this fair value gap here, if it didn't reach 1RR and price returned to this fair value gap, for example, that would have been a beautiful entry too. But like I said, it just shot up and didn't give me a chance to enter on a pullback. On Wednesday, price reached 1RR level again without retracing. So as you can see here, price came down and shot down on this 1 5-minute candle, shot down through my TP, came back up and closed here. So again, no opportunity to retrace, and obviously price went the other way anyway. So that's why they always say wait for the candle closure, right? So I did not get that one. There was no trade on that day as well on Wednesday. On Thursday, as you can see, a lot of stuff happened here. But basically, after those 2 days, I was like, man, screw this. I'm going to enter with a couple contracts just so that in case it moves to TP, I'll get something. That's what I kind of decided. And so, and then I decided, okay, once it retraces, I'll add the rest, and then hopefully the cost basis moves close to where I would like my entry to be. But when I did that, it moved my cost basis, like my entry, way farther than I wanted it to be. So my risk was going to be way more, or not way more, but more than $100. So I decided to close the trade immediately. And then price retraced. So that's what this is, I think. And then price retraced again, even farther back. And I was like, okay, bet I'm going to go ahead and enter, because this was a candle closure right down here. So I decided I'm going to enter on this retracement right here, but it ended up hitting a stop loss. And so my goal is to only risk $100 on these trades to make $150 or more. And I ended up losing $134 on this day because I lost that 48 the first time. And I tried to actually calculate $50 of risk, but you know, price just, it feels you where it feels you, and it made me lose $80 instead of $50. So instead of losing $100, I lost $134. So I guess this might have been $84 right here. And so yeah, that's what happened there. Also says here that to change what I want to do, I think I still want to do what I was talking about here, even though I didn't execute great. Enter with a couple contracts at the candle close, and then try to add more to my position if price retraces to 50% level or better. Okay, that way at the 50% level, my cost basis should still be around this level, which is like hopefully enough to have a 2RR trade if I'm still aiming for the 1RR level. And so yeah, I also considered like if I should trade with the higher time frame, which is something you always hear. Sometimes I figure, well, it's a short-term move with ORB, so maybe I don't have to do that. But in this specific case, this is telling me, or price was bullish pre-market, so I wouldn't have, if I follow that thesis that the overall market trend is the direction I should trade, I wouldn't have taken this trade in the first place, and I would have waited for price to go in the opposite direction. But I've noticed that when price takes the opposite side of the range first, it tends to not retrace at all when it goes the other side. So that also made me wonder if I could enter very quickly, anticipating that price is going to reverse because this is breaking in the opposite direction of pre-market bias. So for example, price was bullish pre-market, and then it went and it hit, it basically went down here and maybe got traders to short here because of this candle closure, right? Like I did, and then it stops them out, and then it goes the other direction. It keeps going. So basically it's just like a pullback and a continuation of the pre-market trend. And so what I'm thinking is maybe I intentionally wait for price to, knock out these short sellers, and then I enter on the candle closure when it closes above this candle closure right here, puts my stop loss below here, and aim for the other side, or at least for $150. So that's going to be a strategy I'm going to kind of look into and study to see if it's viable. And I also kind of thought about it, power of three, accumulation, manipulation, distribution. When you think about the first 15 minutes of the open, that's pretty much accumulation because there's just so much volatility, man. It's stopping a bunch of people out, taking a ton of money from retail traders and stuff. Big organizations are filling their orders. So that's pretty much accumulation. Manipulation is basically if the market is planning on going bullish, let's say, but it closes bearish first so that it can gather some stop loss, like liquidity via stop losses, and head the other way. So basically, the idea is you accumulate in the first 15 minutes, you manipulate to one side, and then you enter as quickly as you can to get a good risk-reward ratio, and you distribute to the other side. So that's another way to trade the orb that I think is something I'm going to look into. So that was Thursday. And Friday, the same thing happened. As Tuesday and Wednesday, price went all the way to my 1RRTP level without retracing at all. So again, no trade. And I tried to be consistent and say, okay, I won't do the thing where I add the 2 contracts and then add more when it retraces. I decided I shouldn't have done that yesterday, so I didn't do it today. And I'm going to try to start doing it next week. So I have your weekly thoughts. I have here 3 times this week, Tuesday, Wednesday, and Friday. Price went to 1RRTP level without retracing. Next week, you should consider 2 things. The first one is enter 2 contracts at market, the 5-minute candle close, and add more contracts at the 50% level if price retraces. That way you can benefit from both scenarios. So that's what I was talking about before. And then the second thought is enter at the 5-minute candle close with enough contracts so that the 1RRTP level is 175 in profits. And I say 175 just because sometimes you might get filled bad and not capture the full 150 points needed for it to count as a winning trade day. Stop loss below the OR. This will be a negative risk to reward ratio, but negative risk reward ratio equals higher win rate. So, once you build up a buffer, even if you lose more than you make on any given trade, you'll get to the 5 trade days of $150 quickly and get a payout. And that's the most important thing. So basically, if you got a nice little buffer, then you just want to try to get those $150 days, right? So to get that payout. So I'm thinking those are 2 viable options. I would need to go back and do some studies and compare them, back testing, and see if these are viable ways to do it, or if I continue doing what I'm doing now. And then another idea that came up to me during the week is opening gap bias, using the opening gap as a bias. So if price gaps down, which means pre-market price is dropping like crazy, then you could, and then at market open, specifically at market open, it also keeps going down. Maybe your bias should be bullish because you want price to fill the gap, right? Because of if it dropped that hard without any retracement, chances are it's going to reverse because it needs to balance the market, right? So at least go halfway or something like that. So I'm wondering if I should trade the orb only in the direction of the opening gap, assuming it's going to fill the gap. And that kind of goes along with what I was saying before, where you can maybe wait for accumulation, manipulation, distribution. So this part right here is the same as what was up there. So just kind of put it down here too. But yeah, this is what I noticed a few times. If price sells off a lot pre-market, making a bearish market opening gap, then it sells off a decent amount at market open too, expect a reversal to fill the gap. And then same thing for the other side. If it rallies up pre-market and then it's really bullish at market open, expect a reversal to fill the opening gap. And then look for reversal at key levels such as previous day high, previous day low, London high, London low. So that's what I wrote down for my basically this week in my journal. Just trying to see what I can do to improve my strategy a little bit at a time, and make it more efficient, make it more profitable. And yeah, that's about it for my oil trading account.